I'm Doug McKenzie.
And I'm John Ward.
And we're the co-hosts of the ABCs of IBC podcast.
Come join us as we share our unique perspective on the infinite banking concept as the creator, Nelson Nash, intended.
Hi, everybody. Welcome back.
Hello. Hey, Doug.
John, how you doing?
As we said, we're kind of, before we started recording, we're both dragging a little bit, but, we're excited always to talk about infinite banking and trying to help people find some peace and serenity in their financial lives. So, yeah, let's give it a go.
I'm down. We'll get into it. I think everybody has those days, right?
For sure. No doubt about it. Maybe not babies, not brand new babies. Maybe they're just always happy. Some.
That's not my experience. Having a 4-year-old.
That crying stuff?
That's not my experience at all. But maybe that unicorn baby exists.
For sure. Well, when I got greeted by your son today, he's very happy.
Yes.
Woo!
Oh, he's always excited when you come over.
He's jumping off the charts there, for sure. That was fun. It's a great feeling, I can tell you.
Yeah.
I know it's great as a father, too, right? When you come home and they're pretty excited.
Oh, yeah.
Yeah. So, yeah. Or want you to start working for them. Do things. I got some ideas. I've been waiting for you to show
little
up.
Dictators. Yeah. But I got home from a business trip a couple days ago, and he ran right up, gave me a hug.
Yeah.
All worth it.
Totally.
Yeah.
Totally. Yeah. No doubt. So...
Yeah, what are we talking about today, John?
Today we're going to talk about a section of becoming your own banker. The section's titled An Even Distribution of Age Classes.
What pages?
71 through 74.
Okay, just in case anyone wants to follow along.
Yeah, and it's an analogy that he does. Again, he's, aside from being a pilot and being an insurance agent, he started his professional career pretty much as a forestry consultant. Mm-hmm. And he kind of kept that up, I think, really late into his life, I'm sure, right? He just enjoyed it, knew it well, and so forth. So, he again uses forestry as an example to show you the power of, generational accumulation throughout these policies, because there'll be many people in the family that'll have them. And he uses the analogy of taking a piece of land, a forestry land, full forest, and 4,000 acres of it, and he breaks them down into 40 compartments of, what am I getting my numbers right? Of 100 acres apiece. Yep, thanks, Doug. And he really starts out by, once a year, he's going to harvest one of those 40 compartments. And at the very beginning, he's got this section that's maybe not as profitable and mature, and right, it's a full forest, so some of the wood grows well, and, trees grow well, and some don't. Some are getting blocked out, right? But let's just say he clears that one out the first year, one of the 40, and then he replants. And then he just goes to the next compartment of 100 acres, and he does the same. And really, for me, the analogy is that, when you start up this business called an infinite banking based policy, right, with the way we try to structure them and based off of, a practitioner helping you structure a policy that's going to meet your needs and desires. Yes, you don't have access to all the best, meaning you don't have access to, let's just use $10,000. You might only have access for cash value of $5,000 that first year, right? Mm-hmm. So it takes time to eventually get to what I call dollar for dollar. I put 10,000 in and my cash value just grew by 10,000, right? Or it might take me, 7 or 8 years, depending on how it's structured, for me to sort of break even, right? But as time goes on, these things become big time cash flow generators, even though we don't call it an investment. So he's giving this analogy that, he goes in and he's always creating some income. So there's some income right from the start, and then he's cleaning out or pruning out the forest of each of these compartments, one a year, right? And takes some of that income because he's got some wood that he can sell. But it takes 40 years for him to get one of those compartments to be at a complete mature harvest.
Oh, so 40 years before he can go back to that first one that he started with.
Yeah, and that he gets the full fruit of the effort of those 40 years, right? Mm-hmm. And so what he's saying is there's money that can be utilized throughout the 40 years. But then the 40 years, let's just say someone started one of these policies at 35 years old and now and they pass away at 75. So he's using the comparison that in a sense you're clearing out the dead wood, no pun intended, but it is kind of, I guess. But there's income that comes from that because that person that dies has a policy. And that rotates into this generational wealth, right? For example, there could be already children, which is the idea. The children have policies, then the grandchildren have policies. And sometimes I describe it as a hole in the policy because people are utilizing these, meaning there's a lien on some of the cash value collateral. And when this person dies at 75 and now there's X amount of dollars that comes through on the death benefit, where are you going to put the money? Well, you're going to fill that hole.
Yeah.
And now you're whole again in all the collateral, all the cash value.
And your collateral capacity is...
Yeah, nice. So generally that's what he's talking about is... We're gonna look at these young people, right? Like he uses the example of the gentleman that started the whole thing. He has a policy. Then he has children, puts policies on them. Then the grandchildren come around, right, and puts policies on them, which is what Nelson did.
Yeah.
He had 47 policies at one time.
And I think that was at the end, right? I think it was 60 something at some point.
Yeah. Well, he started weeding them out and turning them over where he didn't own them anymore, right?
Yeah. Which is an interesting thing that you can do with whole life policies.
Yeah. Well,
because it's a contract that you own.
Sure. Exactly. And so to me, he gets into all the finer points of this, right? I don't know if people can hear me, but I'm, looking at the book myself, and he goes into, there's a number of significant advantages to this plan, right? And he says it covers multiple generation and promotes long-range planning. I mean, yeah, you gotta have a plan. It
requires a mindset shift, though. I had trouble with that one. Do you know what I mean?
Oh, sure.
Because most people don't think that way.
Well, because we're barely able to, cover what we have or what we want, right? I used to say there was there was incredible pent-up demand for any new cash flow that came into the house when I was raising a family and I was married. And And that money went poof,
Well, and it often seems that the most ideal time to start a policy is now.
Of course.
Of course, right? But as early as possible, the better. It's just the simple math. It's the beauty of compound interest.
Yeah.
And the reality, though, is most people don't have as much excess cash flow until they're older. Or they don't think that they do, or they're not disciplined about it. And this is a great point that you bring up here with this. And I think that the analogy that he uses of forestry is great, because to be in forestry, you have to think that way. And he talks about that. You have to be thinking 40, 50, 60 years out. Whereas most people, and a lot of people that I talk to, are really, they're, what does this get me now? What does this get me, in 3, 4 years? And the nice thing is that it does have benefits that you can use immediately.
Mm-hmm.
But the real magic of this does, just like you said, does start to happen decades. Not 1 decade, but decades, 2, 3, 4 decades out. And you're looking at every dollar you put into the policy, you get $3, $4 back.
Yeah. Quite crazy, right? The numbers, he goes into an example of someone, putting $2,000 a year on these grandchildren, and, puts in at age 22, he's put 44,000 in. But then, they're able to pull that money out as streamed cash flow in your passive income years. He doesn't want to say retirement, but of course in retirement,
like that term.
Yeah, he doesn't like, but plus, he pulls out another 3.5 this is at age 85, right? And then at that time, everything's relevant. Again, we're talking about a concept. Is these numbers going to work exactly the same for people today? No, because things are different with dividend rates, that type of thing. But it's all relative, right? And there was also, on top of roughly 3.5 million, there was also like another 6 million in death benefit. Mm-hmm. This is all from putting in 44,000. And there's no doubt that you could be utilizing this cash value to leverage throughout all those years, right? It's not just waiting. And that, for me, it's another episode, but for me, that's really the thing today, is people don't save much, and where they do save, it's locked up. And and that's that really weighs on you when you're trying to, just make ends meet, raise a family, maybe, have a marriage, have time together, alone, going out, doing whatever. And that, doesn't have to be that. It doesn't have to be that way. I lived that way. That was the only savings I had, and it was locked up unless I wanted to take the tax hit now. And I barely could do it, but I felt like I had to do it, because someday I don't want to be doing this work.
Well, because that's you can't see me doing air quotes, but that's the quote unquote responsible thing to do.
Well, sure, it is.
That's what you're supposed to do.
Yeah.
We should do an
life
episode.
Insurance would have been a responsible thing to do.
No, but I mean, you know what I mean?
Which I didn't
That's what
always
everyone tells you
to
do. But we should do an episode, on cash flow versus accumulated assets, because people don't really think about that in that frame very often. But you're exactly right. I mean, and I can tell you from looking at the policy on my son, it's amazing what you get, especially when you look out when he's, in his 50s, 60s, 70s versus what will have been paid in.
Well,
and compared to policies that I have,
yeah, exactly.
The compounding difference is like staggering.
Yeah,
I mean,
it's staggering for sure.
Yeah.
Yeah, I've run a few of these, and those numbers are
You're
big.
like, holy cow, yeah.
And I'm thinking, I'm doing okay with the numbers I have, like this should help, but oh my gosh, I spent my whole life just not doing this most of the time. And so.
Yeah. Well, I mean, and for anyone listening, I mean, the simple reason is because someone that's younger is far less likely to die. So less money buys a lot more death benefit, which gives you more cash value. I mean, it's.
Right.
Yeah.
Exactly. I mean, he goes on to say things like, the underwriting by the insurance company, whether they're going to insure you, the problems are minimized, because there's really, unless there's already a health issue with this baby or this juvenile child, then, they just fly right through. I mean, they don't even do blood work and urine.
No, it's a $1 million policy on Scotty, and it was like, it went through like in a week, I think, with no follow-up from underwriting or anything like that. What's the earliest they can start policies? Is it?
Oh, you just have to have a social security number.
But it's like a few weeks, right? I think there's a...
Well, it takes the parents a few weeks to come out from under the sleep deprivation.
Right. Yeah, I guess our point is you can start that very young.
Pretty much, yeah. Yeah, exactly. And so there's all those benefits, right? You get the tax-free buildup over time. You get the outlay is very small compared to the ultimate yield, like you just mentioned. Generations paying the premiums can easily afford them because they're so low. And then you don't even, not that we want to say we don't want if we've been putting into Social Security, but he says it precludes any need for Social Security. That's the thing, right? Are we going to be self-reliant, right? And that's what we're trying to do is say, hey, if Social Security is there, great. I mean,
I'll take it.
And maybe I can do some good with it, right? In my own family's life, I can provide not just giving it to a charity itself, but I can be charitable to my neighbor, to my family, to my friends, to somebody in need in the community. Like, you don't have to go through some charitable organization to be charitable, right? But you need to have the means, right? So that's really all this, he goes on, but, without belaboring, everything, they put in that kind of
I love belaboring things.
Yeah, but small money, and then at some point he's pulling out, tax exempt $225,000 a year. And that goes on for like 30 years. So that's where all this income comes from. Plus, there's still, it depends, right? How much you're pulling out and how things grow. But you could end up still having at least final expense, death benefit. So
yeah,
even if you decided to tap all of the cash value down to $1, there usually is 20,000 or so left, right? Which would pay for expenses on that end. So yeah, that's pretty much what I had.
Yeah, no, this is I hadn't read this section in quite some time. So thanks, John, for
sure.
I did not do any preparation on this, John. John saved my butt on this, and it was sometimes I have fun just kind of listening to you go through it. But yeah, I always, I've talked about this stuff so many times, and then we talk about it, and I think, wow.
I know.
It really is, because growing up, I had some relatives that put money in bonds for me.
Yeah. Very common.
529 plan. All these things sat unused for a very long time before they were then used, and then they were gone forever. And when we look at in our own lives or in our clients' lives, people that are utilizing these policies that they can put on their kids from a very young age and paying a pretty negligible amount of premium for them compared to what they'd pay on themselves. Not only are they setting their kids up for success really at every turn down the road. You're talking about if they want to start a family, start a business, be stable for retirement, but the parents can also be utilizing these along the way.
Absolutely.
They're of use to the family well before the kid is ever going to need it.
Absolutely. Yep.
With no hurdles to using it.
And you were financing things anyways, right? I had money in 401ks, but I was financing additions on my house because I needed another bedroom, wanted a little more space because now I had 3 children and a wife. There was 5 of us. But I was tying up any extra cash I had, and it wasn't really leverageable like it would have been if I had put my money through this first, right? And then I borrowed from the insurance company to do all those things. And when I paid back the principal, and because it grew, I was kind of regaining some of the interest too, if not all of it. I mean, all the money was available again and would be part of my passive income or of my retirement. Your kids.
Yeah.
Yeah. And then, of course,
because your kids are how old now? Like
31, 26, and 22. So
right. So they'd have, not to get you depressed or anything, but if you had followed the perfect, set of steps there, they would have had policies that were worth hundreds of thousands of dollars at this point.
Yeah, and all the things I did, which is, I paid a couple $100,000 for 2 kids to out of pocket cash for 2 kids to go to college. Yeah, I should have had that money in policies, but I didn't know about this.
No, exactly.
I didn't know about this.
But now you do, and I think the beauty is that we get to share this with people, and the example that you gave is really wonderful, to where Nelson's giving this forestry example of right away, for you, things might not be perfect, but you can set things up in your family generationally to where your family wealth is going to get exponentially better.
Absolutely.
Their situation. So you're setting yourself up better now, but you're setting your family up even better in the future.
Yeah. Yeah. They're not beholden to this system that really kind of enslaves you, right? To always be working for the system.
Yeah.
Like you have to work for them.
Yeah.
Because your assets are tied up in a lot of this financing, right?
Mm-hmm.
They take your car, they take your house. The classics, right? They can take your business. They can take everything that you've worked for because you ran into some trouble.
Right.
And you couldn't make
Lost
the
your job
payments.
for
Not
a few
because you're
months.
just a
Even
slug.
though you paid them for 25 years.
Yeah, exactly. Doesn't matter. There's no goodwill for that, right? And so
it just requires a mind shift change. I know when I was, I said it right this time. I know when I was, probably in my early 20s, I wouldn't have cared about any of this. But I got to a point in my late 20s, early 30s where, having had a child and kind of settling down a little bit, this stuff becomes very important. Of course, I wish I had taken that a little bit more seriously earlier, but like we always say, now is the best time to start.
Yeah. Yeah, because you only know what you know when you know it. And part of why you're doing this today is because you've experienced certain things financially and life experience and had perspective. And then you said, oh, yeah, this is something I'm going to put my heart and soul into. My energy is going to go into this because I know it's good for people, right? There's a lot of different things you could do, Doug, right? There's a lot of different things we could have chose to do with our time.
Yep.
Right? You didn't get forced into being a life insurance agent. You didn't be forced into becoming an infinite banking.
No, I didn't get forced to record.
Guys, I need a job. No, we chose this profession.
Yeah. We also choose to get together and record this podcast on Saturday mornings.
Yeah. Yeah. And it's fun. It's always fun. So thanks everyone for continuing to listen to us. It's and for the feedback that I've received, it's been I know it's good for everyone it's definitely good for my clients, hopefully for prospective clients, but certainly it's a good reminder, and that's what we're trying to do too, is not just teach the ABCs of IBC, but to remind people that have already chosen to go down this road why they really did choose it. And help them kind of flesh it out a bit in their own minds and use their imagination of how to utilize these policies, how to implement it through their family. Yeah, it's all great. Yeah.
And one thing I want to mention too, I don't think I've ever said this. I know you've had this experience too. John and I, that's what we do. We'd love to sell you some life insurance, of course, if it's a good fit. But we've had people reach out that have listened to us where it is not the right fit for them to incorporate this strategy in their life, based on factors that and John and I are happy to be sharing this with people who may or may not even be practicing the infinite banking concept truly.
Sure.
And we definitely don't want to steer people towards something that wouldn't be a good fit in their lives. Because I've had people that have reached out that are 75 years old and they want to take a chunk of change and they want access to all of it right now. Well, a whole life insurance policy is not the right fit, and I'm not going to sell that to you.
Well, I think you probably going to listen to the next episode because we're going to get into some of that. And, those people, it's not always just about you. It's, there's other ways to share it, or to implement it in an insurable interest. And,
yep, absolutely.
And still be beneficial to you in some way, hopefully, as long as you live. You know?
Yeah.
Okay. Great.
Thanks, everybody.
Thank you. Talk to you next Friday. Or talk with you. Listening to ourselves talk, and hopefully you're enjoying it on your end. Thank you.
Have a good weekend, John.
You too. Thanks, Doug.
Thank you for joining us for another episode of the ABCs of IBC.
If you enjoyed listening, please hit subscribe and leave us a 5-star review wherever you listen. It really helps. See you next week.
Bye.